Welcome to CBRE's 2026 European Real Estate Market Outlook. Let's start with the macro picture. On the one hand, there is still a lot of uncertainty and we expect another year of slow growth in Europe. On the other hand, we also expect inflation to further drop this year, leading to further base rate cuts. These falls will help the consumer and will support growth. On top of all that, we also have the rapid growth of AI that will affect all aspects of life and work. So, what does this mean for commercial real estate? Let's start with the investment market. We expect the recovery to continue, led by greater pricing clarity and stable interest rates. The recovery is still in its early stages and will be gradual. We expect more product to be put up for sale this year. Debt maturity or equity rotation will remain the main drivers for selling. Lenders are also keen to lend, and competition among them is leading to lower margins. Borrowing costs are not expected to fall much further due to the expected levels of base rates and long-term bond yields. In general, investment returns will be driven by income rather than yield compression or cheap debt. According to investors, the most attractive sectors for investments are the living sector, followed by logistics. However, the offices sector has made a comeback this year, especially for LPs. Alternatives, such as healthcare, will also remain in demand. Finally, we expect M&A activity to remain strong in 2026, with buyers seeking to capitalize on arbitrage opportunities in both public and private markets. Now, regarding sector fundamentals. All sector fundamentals remain solid, with offices leading in terms of returns, followed by retail and logistics. Living sector returns are also attractive from a risk versus return point of view. Now, let's briefly touch base on all key sectors. Supply and demand imbalance remains in the living sector, and we expect strong rental growth. Offices. Tight supply and cost considerations are pushing occupiers to explore alternatives outside core locations, therefore creating opportunities in these peripheral markets. In logistics, we expect moderate improvement in take-up of space. However, occupiers are vacating old units and moving into new instead of expanding. In retail, prime high street and retail parks will continue to outperform, but prime shopping centers rents are also expected to trend stronger. In data centers, escalating demand, increasing but still tight supply, and grid limitations are expected to continue to drive upwards pressure on pricing. Finally, hotels are expected to see modest growth driven by tourism and the return of business travel. Supply of new space is expected to remain low. If you want more insights, head to our website for the complete report.